I did it. I bought 100 shares of the Qs. I did a covered call trade yesterday. Well, the Q was trading at 222.31. I only paid $218 for it. How? By selling a call option against it at a 220 strike. So what does that mean? What's the consequence of selling a call option against my shares? What that means is by February 7th, there's an expiration next to my call option. By February 7th, if the Qs is trading above 220, regardless where it is trading above 220, if it's 225, 230, 221, the max I can get for my shares is 220. I'll have to sell my shares at a 220 price, regardless of where the Qs is trading at. But remember, I only paid $218 for it. So this trade sort of guarantees me a $2 profit per share as long as the Qs is trading above 220 come February 7th. Now, as soon as I bought it, the Q started to drop, and now the Qs is trading at 220.14. So it looks like there's no advantage there. But let's say come February 7th, the Qs is trading below 220. I end up keeping my shares. I don't have to sell them at 220. And what I could do is sell another call option at the same strike of 220, collect another premium. So initially, I collected a $2 premium, 220 minus 218. If the Qs stay above 220, then I confirm that $2 premium. 220 divided by 218 is almost a 1% return. So if I annualize that, that's about 31%. That's if I continue making the same return on this type of trade. But basically what's great about this trade is while it was trading at 222, I basically gave myself some downside protection. So even if the Qs drop by $2, I still make an expected return of 1%. But what's great about it is when the Qs was trading at 222, I only paid $218 for it. So I gave myself a $4 protection basically up until February 7th. So if I had just bought the shares alone, for me to make a profit or an income, I have to sell the shares higher. But I don't know where it's going. It might go up, it might go down. In this case right now, it's going down. So I still make a profit even if the shares go down because I sold premiums against it. I sold a call option against it. And the only consequence of selling this call option is come expiry date, I'm forced to sell my shares at the chosen strike price. So I forego capital appreciation. But in return, I collect a consistent, I wouldn't say consistent, but I collect an upfront premium. Now, in the long run, is it better to collect that upfront premium or just to keep your shares? I don't know, some years, of course, it does look better to just hold shares because we're in a bull market. But sometimes you find that whatever you've gained in 5 years gets wiped out in a year. Or for full 5 years, you haven't gained anything. Right now we're in a bull market, but we're not always going to be in a bull market. If you look at this 5-year period, you could see that we started off at 45, we closed at 60. So that's not a great return in 5 years. So what's my plan with this trade? So if it goes above 220, I get my money back and I make my 1% return. And then with my money, with my capital that I get back, I'll do it again, buy the same shares again, go a little bit lower, choose a strike that's lower than the current market price, collect a guaranteed premium or an almost guaranteed premium. If the Qs end up going to 215 or 210, well, I'm still in a better position because I collected almost $4 of premium. So what I could do then is either sell another call option, but obviously if I sell it at the same strike of 220 and the stock is trading at 210, there'll be very little premiums in the 220 strike. So either I'll choose a lower strike, but then I have to be careful with the expiration. I have to be careful that the stock does not surpass my lower strike come expiration, or I could play it safe, stick to my 220 strike, but then maybe go further out to collect enough premium. But because the reason why I'm choosing the Qs or an ETF that tracks the NASDAQ is that the general market always goes up over time. So even if it does drop temporarily, I'm confident that the ETF will rebound and eventually come back up again to my original strike. I've been doing cover calls on stocks and I just got burned so many times with stocks that fall more than 30-40%, and now I'm stuck holding a stock that's down 30%, trying to sell covered calls or trying to sell call options at a much lower strike than my purchase price. And then I end up being stuck if the stock goes up a little bit and surpasses my strike. So for example, Grubhub is a great example. I bought the stock at 74, collected a lot of premiums on the way, but then when it dropped 50% to $35, I sold a call option at a 40 strike, and then 45, and then 50. And now my last strike right here is 50. And the stock's trading at 56 and my cost is 74. So if I do nothing, I risk losing my shares at $50, but my cost is $74. Because when you sell a call option, your consequence, the risk is you have to sell your shares at that strike price come expiration date. And if you don't want to lose your shares at expiration, you're going to have to buy back the call option. And if you buy back the call option, then you're going to buy it back for a debit. So you're adding more money to your cost basis by buying back a call option that's in the money. It's in the money because the current market price is above the strike price. So now I have to try to recover from this trade so that I don't end up selling my shares or losing my shares at $50. So I have to roll the call option forward without paying for it. That's the ideal scenario. But that's what happens when you don't buy quality stocks. So to save myself this trouble, I decided to stick with ETFs that track the general market and that always go up over time. So I'm going to try it with the Qs on a weekly basis. I'll aim for a 20% annualized return. So if you look at a 5-year period, the last 5 years, the Qs was at 108 and then 220. So you see, even if it drops, like it dropped hard in December 2018, it eventually came back up. Didn't take long either to come back up and then just totally destroyed it and went even higher. Over here, you could see at the beginning of the first I guess, 2 years, it's been relatively stable. So this would have been a perfect time to sell covered calls. But obviously these rallies over here is not the perfect time to sell covered calls because you would have made more by holding on to the stock. But of course, you don't know if you're going through a bull market or if you're going to go horizontal or if you're going through a bear market. So I'd rather go with what's more consistent, and in my opinion, and from what I've seen and read and heard, covered calls is the best, but there's different ways of using it. For example, if I think we're in a bull market, I could sell a call option at a higher strike. So if I bought the shares at 222, I could have sold a call option at a 225 strike. Would have collected a smaller premium, of course, but I would have taken advantage of capital appreciation plus that premium that I collected. But I don't know where we're at. So I'd rather guarantee myself a 20% return every year. That's what I'm trying to go for with this type of cover call trade. So right now with the Qs dropping to 220, I'm not going to do anything. I still have until February 7th. There's nothing to do. I could wait to see what happens until next Friday. And like I said, if it's above 220, then this trade I win. If it's below 220 by not much, I still win. Now if it's trading at 210, as long as I don't sell my shares, it's not a confirmed loss. I am in a losing position, but at least I'm in a much better losing position because I collected $4 of premium. And then once the call option expires, I have the choice. I could sell a call option at my previous strike, or I could even sell at my initial cost, which was 218. Another reason I like buying the Qs or the SPYs is because it's got a margin requirement of only 20%, while other stocks like Facebook has a margin requirement of 30%. So the advantage of that is, since my TFSA is linked to my margin account, it affects the buying power in my margin account. Whatever I buy in my TFSA affects the buying power in my margin account. So although I only have $2,000 of equity in my margin account, I actually have $120,000 of buying power in my margin account because it's linked to my TFSA. That's an advantage that Questrade has. Now, if I buy stocks that have a 30% margin requirement in my TFSA, I'm going to have less buying power in my margin account. So the more buying power I have in my margin account, the more put spreads I can sell. Now, all these put spreads are mostly in trouble now because of the market dropping, but that's a different story. I still have a lot of time on them. They're all mid-February expiration. Now, I was actually waiting. Before doing this trade on the Qs, I was waiting for Apple to drop after earnings. I really thought Apple would drop after earnings, but it went even higher. So now, because I know Apple is a big part of the Qs, so now I'm not going to wait anymore. Although there's a lot of negativity in the market, people are talking about recession or crash, but I don't like waiting for the market to drop in order to get in because I don't know when that's going to happen. I could end up waiting 1 year, 2 years, or even more, and then my capital is not being invested. So I'd rather find a strategy that works all the time, works if the market's doing well, and also works if the market drops. So if the market drops, in this case, obviously I'm going to be down on my shares, but I can still collect something out of the shares, out of the capital, by selling call options against it. But it's just a matter of choosing the right strike, a safe strike, because if the market drops, you can no longer sell. If this ETF drops to 180 or 150, I can no longer sell a call option at a 220 strike, of course, because there's no premium in it, right? The further I go, the premiums decrease. So at some point, if the stock is trading at 180, I've got no premiums to collect. So I'm gonna have to get closer to the current market price, even though the current market price is far from my cost, from my purchase price. And once again, the risk of selling a call option at a strike that's lower than your purchase price is that you risk losing your shares at that strike price if the stock moves up past that strike price come the expiration that you choose. So what I like about this strategy is even if the market goes down, I can still collect income from my capital as long as I choose the right combination of strike and expiration, so I don't end up in trouble. So obviously if the Qs is trading at 150, for example, I'm not going to sell a call option at 155. I'm going to try to go as far as I can while still collecting a decent premium. So maybe go 160, 165, but 1 week out. So I'm making the assumption that the Qs will not move from 150 to 165 in 1 week. So I collect my premium from the call option and I'm still safe. I don't end up losing my shares at 165, which is a lower strike than my initial purchase price of 222. So I'm going to be making a video, more in-depth video on how to trade covered calls on Questrade. So in this video, I just wanted to share that I bought 100 shares of the Qs. It always scares me because it's a big amount, but if I think of it, it is the safest investment I can make, because even the brokerages consider it a safe investment because they give it less margin requirement. But basically it is a group of all the best stocks on the NASDAQ exchange, so it's safer than buying one stock. Alright, so if you have any questions, leave in the comments section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.